Hey everybody, this is David Skrika. Yeah, today we're going to look at the US dollar. So what's happened recently is that myself, a lot of people, myself included, when the Federal Reserve looked like they were going to start to cut interest rates this year, thought the US dollar would fall because it looked like to me that the European Union and other central banks were going to kind of keep the rates higher, like because if you, especially more so in Europe, and remember that U.S. dollar index, the one we all follow, not the trade weighted one, which is like every currency around the world, but this one here, the USD, it's mainly the euro. Like I think the euro is like half of the weighting. Then there's the pound, yen, Canadian dollar, Australian dollar, and so like 60% of the weighting, if you look at it this way, being the pound and the euro, basically I felt was going to be lag the US in cutting rates, and that could keep their currency stronger. So, but it looks like here, like we've gone through the highs of like a few months ago, and I think we could go back to these highs last year. And part of the reason is as you know, like I'm flexible in my views, and I can admit when I'm wrong. I think it's a big part of something you have to learn because it's easy to be stubborn in markets. And I was wrong about I was right in 2022. I kept telling people the Fed's going to raise rates more than people think. I remember reading articles at the time. Oh, they'll go to 2-3%, like they did in 2018. And I'm like, no, no, no. Inflation is 8% right now, and they cannot just like raise rates to 2%. They're going to have to probably raise rates to 4 to 5%. And of course, they went way over 5%. So I was way more hawkish than more people. Then I was a little more dovish, but now it just looks like that's not going to happen. Like I said, when I look at I talked about the TLT kind of falling, and we're looking at you can see here the U.S. dollar index rising here. So, and it's really interesting that the U.S. dollar index is rising, and commodities are rising, and gold is rising. So that's interesting as well, because back in 2007 when we had this rally where everything went up before the crash in 2008, the dollar was falling with also oil rising, gold rising, stocks rising, etc. But now we're seeing a strong dollar with also strong commodity and asset prices, and that's just kind of interesting. It's just probably a sign that the U.S. is, kind of what they say, that the cleanest dirty shirt, or the least dirty shirt. It's just as of now, the other currencies are good, or it's not as bad as the other currencies. Because the problem, two other currencies that are in the US dollar index are the Canadian dollar and Australian dollar. And being Canadian, I follow what goes on there quite closely. And the problem in Canada is Canada's a gigantic real estate bubble. Like, you think the US has a real estate bubble? The median price of a house in the US is just over 400,000 right now, or near 400,000. In Canada, it's like, I think it's 700,000 or 800,000, because most of the market is in Japan, or Japan, and is in I'm thinking Japan because the real estate bubble happened in the 80s. There is in Vancouver and Toronto, and you're talking the average price in those markets is 1.5 to 2 million. That's average price. It's funny because I sit and look around my house here in the Bahamas, and I have about 3/4 of an acre of land, and it's on a hilltop. It overlooks two oceans. My house is pretty average in my opinion, or above average, but I did a big renovation about 4 years ago, and I put in new floors, new roof, new deck, tiles, these really nice tiles on the wall, all this sort of thing. Anyhow, long story short, I don't want to bore you with my home renovation, but I figure my house here is worth 800,000 or 900,000, up from about 3 to 350 where I bought it. And a house like this in Vancouver, overlooking, the ocean, or in Toronto, overlooking the lake, I think it'd be like 3-4 million. And I don't even think my house is that great. I just think that's what it would be. It's just that's what the prices have happened there. But of course, and the issue is the favored mortgage, and I've talked about this in the past, in Canada, is a 5-year fixed. Well, most people did that in 2020 and 2021 when the rates were zero. So you're talking next year, 2025 and 2026, is when a lot of those have to roll over. I actually have a relative who's going to have problems paying his mortgage, because all he really does is pay the interest, and his 2 to 3% mortgage is going to be like 7 to 8%, and that say he is roughly $1 million mortgage. I don't know exactly his situation, but he's going to go from paying 20 to 30 grand interest a year to 50 to 60, and he can't afford that. He's a cook and his wife is a nurse. so they don't make a huge amount of money. So, and you know what I'm trying to say is the Australian dollar, Canadian dollar could be under pressure for a while, even with higher commodity prices. We'll look at the Canadian dollar here. You look at, you can see it's looks like it could fall. I think I could see the Canadian dollar falling back to these lows of 72 cents, because they're probably going to have to more aggressively cut rates because of that housing bubble being much bigger there. And we go look at Europe. You know, European inflation has actually come down faster, so they have leeway. Yeah, the euro, after this nice rally here, looks like, you know, it could break this support at some point at 107. And again, you go back to the lows of last October, which is 104. The last two, you know, summers when I've been in Europe, it's been about par. And then, of course, the pound, which had that, you know, crash a couple of years ago to par, it's actually held up better, but even it is now at the support level around 125. And if it broke that, again, you could go back to 120 or something of those means. So I don't want to get too bullish on the dollar, but it just looks to me like, you know, you can see we're pretty overbought here, so we can see a short-term pullback. But it just looks to me that with the U.S. probably not going to raise rates as much as people think, we'll continue to see this dollar strength, you know, and maybe that help bonds a tiny bit. But again, that's another dichotomy, that we're not seeing inflows to bonds even with the dollar strength. Most of, I guess, the inflows are going into commodities. So and again, like it's a, well, again, we continue asking ourselves, well, the dollar's going strong, but is it just the least dirty shirt, as they say? So we'll have to see. So it'd just be interesting to see, because we have all these like kind of like things that don't make any sense, like historically, like strong gold prices and commodity prices with the dollar strong, weak bonds with the dollar strong stock market with the dollar strong. So all these things that don't normally line up are kind of lining up at the moment. So it's tough to figure out what it all means. But what the purpose of this is, I just wanted to show you, you know, with interest rates less likely to come down that much this year, and probably with now, you know, Canada, Europe, Australia, etc., cutting rates more aggressively, probably this dollar strength is going to keep up for a little while. So I hope you enjoyed the stock chart of the day. I think you're going to find my stock chart tomorrow very interesting. I'm actually doing one of my late nights. I've talked about this in the past. Not much going on here at night on the island, but I like that, because I late at night, I can get up in the middle of the night sometimes like this and just work, or work late at night. It's kind of, there is something cathartic, and it makes you, and also for me personally, it makes me more productive when I get up in the middle of the night. It's quiet, it's dark here, there's not light pollution here, so you can see all the stars, and you can kind of just sit down and work. And there's something, like I said, when I'm talking about being more productive, is there is something about working, you know, at 4 or 5 in the morning when you know everyone else is sleeping and it's quiet. And here I do have guys, it's part of the culture here, some of the local guys just kind of come to my house and, you know, to drop in, say hi, and without, you know, calling. And I've told them I don't like that, but it just happens. So I know at 4 or 5 in the morning, that's not going to happen. So I hope everybody's doing well, and I hope you enjoyed this little tidbit on the dollar. So then we're going to look tomorrow. We're going to look at the similarities to the market now in the 1987 crash. Now, I never liked those charts where they, you know, correlate two markets exactly, but when I did my thing on Paul Tudor Jones in my legendary trades series, I talked about him, you know, shorting the market before the 1987 crash, and how he was just doing a correlation of the 20s boom and the 80s boom in stock prices, and that was one of the ways he predicted it. But the correlation is quite interesting right now between the stock market from about mid to late 1986 to, you know, the spring of 87. So we're going to show that. And yeah. So I hope you enjoyed that when I show that.